everybody will be seated, we'll get started with this final panel, but certainly, hopefully we can, wrap things up down to a more micro level, since we've just had a 30,000-foot view over yesterday and this morning. Let me introduce, the title of our panel is Incorporating New Risk Measures into Property Valuation. I want to introduce Tom Showalter. Tom is the Chief Analytics Officer at Digital Risk, and he'll be our presenter today. And then our discussants are Scott Reuter, VP of Valuation Management of Bank of America, Eric Schwartz, Amegy Bank, Chief Appraiser, and Bill King, SVP of Valuation Solutions at Platinum Data. Tom's white paper is hot off the presses, and a copy of it is out in the foyer. One of the things that I think Tom's study will terrify you a little bit, and then it certainly did me. It was an eye-opener to actually look at the analysis that he did. And then all the discussants are all actually real estate appraisers. So we hope to offer some solutions to what we think were discovered in this analysis. And we're going to present that in terms of the 3 Ps. We're going to look at people, policy, and process, and put the solutions into those buckets, and hopefully walk away with some action plan. Tom?
And can you all hear me? Good. Okay, let me tell you just, first of all, thank you all for being here, and thank you for having me. It's a real pleasure. Many of you may not know much about digital risk. I'm going to give you 30 seconds worth of what digital risk is and why we have data that might be of interest to you. Digital risk got its start in 2006, 2007 as a forensic audit firm going over bad loans produced by the meltdown. And so we analyzed those loans for something called manufacturing defect. And a manufacturing defect may be that the house was valued as $400,000 at the time of origination. It was actually worth, by our best estimates, $300,000, and so that would qualify as a defect in valuation. We also did analyses on income, asset liability, and occupancy status as posted on the loans. In the course of business, we reviewed, from a forensic audit standpoint, approximately 725,000 loans. At 4 hours apiece, you can see that we have a huge investment in manpower in creating these findings, which are really auditors' opinions. And we funnel those findings down through a very elaborate maze of details down to 6 or 7 basic material defects, one of which is valuation. So that's where we get our data from, and from that data we've then created models that take commercially available information and estimate the likelihood that that particular appraisal is defective, or the likelihood that that loan or the income amount posted against the borrower is not representative of the borrower's true income, and so forth. So we call that manufacturing defect. And let me just start the presentation here. Here's just an example of what happens when manufacturing defect is present. And what we're really stating here is the information surrounding the loan, the information that follows the loan from origination through issuance into the secondary market, in some cases has very defective numbers. And so, for example, here we have an appraised value on the right of $250,000, but the quote-unquote true value is estimated as 200, and so therefore the LTV, which was thought to be 80, actually went to 100. And the same is true down there for income. So what we're really stating here when manufacturing defect is present is that the information surrounding the loan, key data elements like LTV, DTI, valuation, and so forth, have lost their information value. And so that means this is not necessarily a conversation about fraud. We're not really trying to impute whether there was malicious intent or any kind of something afoot. Some of this can be just done due to inefficiencies in the system, data handling errors, or what have you. But we are professing that manufacturing defect is a part of the manufacturing process. and it leads to something called repurchase, which means that the issuer and or the lender, the issuer or the investor, especially if the loan goes in default, examines it for defect, and that has resulted in the putback of the loan to the lender, who then has to buy out the investor. That's a very economically significant event. Digital risk alone is probably accounted for well more than $85 billion worth of putbacks, which is a lot of money. It made it real popular in the lending community. I'm surprised B of A is on the panel. Actually, we've managed to take that information and create a technology around it. It's called Veritas, and it estimates the likelihood of defect in a loan using automated methodologies. But anyway, here's an example of manufacturing defect, and as you can see, if you're the investor and you're analyzing this loan, this defect, this error, this risk is hidden from you, and unless you have either an opportunity to manually review all the loans for defect or some sort of tool, you really don't know it's there, and you're highly likely to underestimate the risk. Now then, this is just a distribution of what manufacturing defect looks like, and all the loans on that side have very little defect. So actually the exposure for repurchase is largely in the far right. And so that means that this is not a frequently occurring phenomena, but relatively infrequent, maybe 10% or so. But a small portion of the loans have almost all the defect, and the rest of the loans have very little repurchase exposure. However, unless you have a tool that can tell you which loans in your portfolio have a potential for defect and which don't, you're left with a very difficult reserve allocation problem, in that you have to take all the exposure on the right and spread it out over all the loans on the left. And that means that on the left-hand side, you've over-reserved for repurchase, and on the right-hand side, you've under-reserved, and that can get expensive. Now then, in terms of defect, what we have here is a look at our portfolio using both Veritas and also our forensic audit results. And you see the big blue space, which is valuation error. And you can see that in this sample, which is in the hundreds of thousands, we have approximately a 60% valuation error rate, which makes it, from our perspective, not necessarily from everybody else's, the most significant error in terms of manufacturing defect present today. And we will get into that in a little more detail. But those are our findings. And by the way, what we've learned about this topic of manufacturing defect is, as you go from lender to GSC to investors and so forth, each party, each entity seems to have its own specific definition of what they consider a defect. And it really has to do with how their business model works. So if you're a mortgage insurer and you want to find defects, you're really looking for defects that do what? Enable you to legitimately rescind the mortgage insurance in the case of default. If you're an investor, a defect is something that will legitimately allow you to put back the loan for repurchase, and so on and so forth. And so this has been somewhat of a challenging event to model, but we've nonetheless done a very good job, I think, of creating consistent definitions around various kinds of defects and modeling for them. Now then, I've published a number here. I do this with great trepidation. These numbers are the result of various samples we have analyzed and what the various defect rates have been. This is not to be confused with a rigorous academic review of all loans, and therefore we're not publishing an unbiased estimate of the rate of defect in the population. But in the samples we have reviewed with respect to valuation error or appraisal error, we found some samples as high as a serious defect in 1 in 4 loans, 1 in 5 loans, and some as low as 1 in 12 or 1 in 14. My guess here is that on average in this array of samples, we have found a serious valuation error in 1 in 7. And a serious error is plus 20%. So in other words, the appraised value is plus 20% greater than the true value of the property. And so where did we get the 20% from? Let me tell you about another study we did we at Digital Risk not only have an analytical staff, but we also have appraisers. And we conducted a study with a few thousand appraisers, a few thousand appraisals, and a few hundred appraisers. And we did a repeated measure study in which we gave the same property to multiple appraisers to evaluate, and not telling any one of the others what the true value was, or what the original appraisal was, or what any of the other appraisers found. And so what we discovered there was that there was a significant variation in the values determined by each of those appraisers on each of those properties. And the standard error of that was approximately 8%, and the confidence limits would have been about plus or minus 15%. So that error rate was rather significant. A standard deviation of 8% and a confidence limit of plus or minus 15 suggests that, for example, a $300,000 house, 95% of the appraisals may come in anywhere from 345 down to 255 and points in between. And that was a pretty significant range. So when we were trying to decide when a valuation error was present, we needed to get a number that was significantly higher than the typical precision of the appraisal. So that was plus or minus 20%. Now then, what you see below here in this graph is our estimate of what the LTV and the frequency is per category versus what lenders have in this sample. And you see that the biggest differences are at either ends of the spectrum. When you're dealing with an LTV that's reported by the lender as less than 75, you see that they think approximately 50% of their distribution is there. Our value estimates, which were corroborated not only by Veritas, the tool, not only by AVMs, but also by individual audit, we determined that the frequency of the population that was less than 75 was around 30%. And as you can see, that sort of cascades up to the population that looks like it has an LTV of greater than 100, where the lender thinks that the client thinks that their population has less than 2% of the population has an LTV greater than 100, and our analysis shows it to be more like 18 to 20. And so there's a significant difference between what the lender has in their system and what a manufacturing defect type analysis might suggest. And so there's a lot of reasons for that. We can get into that shortly, but let me just give you a couple of examples of what we found, just to give you an idea of what this looks like at the loan level. This is actually a house in Pensacola, Florida. It was appraised as $111,000. Our review determined it to be worth $42,000. Now, our review was based upon comps at the time that were similar to the subject property, all the standard appraisal methodologies in play, with adequate access to data on the entire market. So obviously, there's a big difference between our review and the appraised value. So this one obviously would qualify as some form of defect. Now, maybe if you wanted to buy this house and they threw in the car, maybe you could get $111 for it. But anyway, obviously, the lender doesn't necessarily see the picture when they scribble on the loan amount. Here's another one, and this one's in Springfield, Ohio. Appraised value about $90,000, desktop review about $55,000, and again, a significant error. In both of these, two things were apparent. First of all, the borrower would be losing their down payment. You know, if the house is truly worth what we think it is, and the borrower does put money down to get this kind of a loan, he's underwater to begin with, and it's hard to recover. Secondly, the tools we developed can accurately estimate that these are, in fact, high-risk appraisals. Now, here's one that's appraised value $155, desktop review $155, and that's Las Vegas. Now, this leads to and suggests a little theory here, and I'm going to delve into it for 2 seconds. And that's the fact that in complex markets where properties aren't necessarily very homogeneous, there's probably a more difficult appraisal problem, and you're probably more likely to get some disagreement over what the true value is, and therefore a higher likelihood of error. In this particular environment here, where you're probably dealing with a tract developer, and this is Plan B, and 15 Plan Bs have already sold in the last 6 months, it's a lot harder to get it wrong. But nonetheless, it's gotten wrong on many occasions. Now then, I'm going to go back one. I want to make one comment here. Many times these kinds of errors are attributed to some sort of malicious intent on the part of the appraiser or some sort of collusion between the seller, the buyer, and the appraiser. And while I know and have data to prove that that's in fact the case, I would like to offer another theory, and that's that the problem of appraising and valuation is maybe a bit more difficult and challenging than the current methodology really will support. In other words, the methodology is not precise enough to support the needs of the market and then support the needs of the secondary market. And so many of these problems are due not to fraud or malicious intent, but just due to systemic weaknesses. And therefore, a solution might be more systemic than it would be otherwise. This is another example of economic impact. And what we found was that the bottom score there is the Veritas score, and as you go to the far right, you're getting into the highly likely to be defective loans, and you get into the far left, you're getting into the very undefective loans, risk of defect less than 1%. And there's two lines here, with the vertical axis being the default rate. The negative equity line is the red boxes, and the positive equity line is the blue boxes. And as you can see there, the likelihood of default for the positive equity, regardless of manufacturing risk, is very low. Doesn't change much, no correlation. But when you look at the negative equity, you see that interacts severely with the likelihood of manufacturing defect. So what we're proposing here, and what we found out in our modeling, is that as you go into modeling default, especially default within the first 12 to 15 months, you really need to start considering manufacturing defect as one of the reasons why the borrower may get fed up and walk away, especially if the valuation error is a big part of the manufacturing defect. You can see that there's an economic reason why they might want to walk away. Okay. Took a bit of a sharp pencil to come up with some estimates here. The methodology is, I'll explain in a second, but what I tried to do is say, okay, if there's manufacturing defect and you're buying a pool of loans, what kind of risks are you going to incur economically? So the probability of default or loss frequency, you see here that the vertical axis is a percentage, P default, and the columns are manufacturing risk yes, no, and overall rate. So what you're seeing there is that if there's manufacturing risk, the likelihood of default's gone up. It's about 90 plus basis points in this analysis. And then the cumulative default rate given manufacturing risk is calculated through a Bayesian methodology. But basically you see there that the probability of default cumulative given manufacturing risk is about 2.25%. And then when you go to the next one, the far left, the probability of cumulative default given manufacturing risks no is 1.28%. So you're seeing some significant differences here in loss frequency. Loss severity, this includes valuation and non-valuation error, but you can see some huge differences here in loss severity when manufacturing risk is present. And I would suggest that 63.9% effect is in two populations, much bigger if there's valuation error and much lower if there's not. But nonetheless, it's a significant figure. And then expected cumulative loss rate, you combine all that together, you get roughly a 80, 90 basis point loss hit when there's manufacturing defect present. And so therefore, in terms of economic significance for the people who are buying a loan, not that this is a huge deal and they're all going to go broke, but it does affect returns. And it also, I think, more than anything, affects their ability to correctly analyze the risk in the portfolio they may be buying. Because what they're getting in the loan file is only the LTV or only the DTI. They're not getting sufficient information in order to evaluate the veracity of those particular statistics, and that's a big deal. Okay, some of that, and this is all the equations, and this is some Freddie and Fannie data used to support the equations. So for those of you that want to take a sharp pencil to my sharp pencil, start on page 16 and go through 17, 18, and 19, and you'll see how we came up with the numbers. So basically, that's my thought, and I have two questions to pose to the audience. First of all, obviously we, meaning digital risk, have a thesis that the current appraisal methodology just isn't sufficiently precise for the for the task, in our opinion. But I wanted to know if, in your opinion, you thought that was the case, or you think it is sufficiently precise. If you think it's not sufficiently robust to do the task, what suggestions might you have for how to make it better? Now, my colleagues on the panel here have some ideas, and at Q&A, we'll look forward to your input. Thank you. Okay. Bill? Okay, it's
why Joan-
Scott's turn. Hold
That's
on.
why
hold
Joan's
on.
sitting next to me.
You're not up.
I don't have slides.
You don't have slides?
No, these are Bill's.
Okay.
They're great slides, though.
I'm sure. Okay.
Thank you, Tom. Firstly, a quick thank you to Ed Pinto for the kind invitation to join you here, as well as my good friend Joan Trice for consideration for inclusion on this panel. So I do greatly appreciate the thought and the consideration. At the core of the U.S. Financial collapse was the lack of an objective standard of safety and soundness in the mortgage underwriting and in collateral risk assessment. It's not an original statement. That's the first statement on Mr. Pinto's conference agenda, and the premise of what we're going to cover here today. Our panel, as Tom has teed up for us, is relative to the valuation piece of that and the initiatives and concerns around collateral risk assessment. Joan has challenged us as a panel to talk about solutions. Tom, in his presentation and all the awful things he said in general about the industry and specific to my employer, all kidding aside, no. So, but he makes a great point. Digital Risk is a fine company, and I know Tom, and a lot of research went behind what we on the lending side and we at banks suspected was there anyway. There are a lot of hidden risk behind the loans that were being booked. As he touched on
the stoning begins at noon, just so you know.
What's that?
The stoning?
The stoning. So obviously touched on a lot of things we're concerned about inside of a bank, both the things we know and we don't know. So we put processes in place and layer in, hopefully, professionals and subject matter experts where needed to try to stay in front of this. To me, I hear this and I'm concerned about how we get to more credible appraisal reports. Joan has stated that my portion of the panel here is people in the process. I think clearly as an industry we have opportunities to improve, starting with defining the role and the ever-changing role of the appraiser. You know, what really do we want that person to do? You know, Joan and I have gone back and forth on emails. Do we want them to measure and take photos? Or do we, on the other side of the spectrum, want them to analyze large data sets? Well, for the former, you really don't need a lot of education or a college degree or training in appraisal techniques to do that. On the far end, we don't compensate or train enough to require that of a licensed certified appraiser. But I think as you look at the human element and the advances in data and analytics, I don't know that those necessarily need to be opposing forces. I tend to subscribe to, and I believe the Latin phrase is in medio stat virtus, in the middle is virtue. I think somewhere in the middle we can get to an appraiser moderating those two ends, taking the always needed human element and rationalization and reconciliation and the other elements that an appraiser's expertise brings to it, as well as being able to manage the advances in automation and analytics and data and use some of those as tools in the current body of scope of work of the appraisal and a residential appraisal, for instance, that currently isn't there, at least not there with any consistency. In thinking about this, I think there's probably three main things I would like to see, and I'll challenge my panelists as well as Tom and Joan in the audience. One is I would love to see us as an industry solve for the point-in-time valuation. And I think there's a lot of misconception from the users of reports around that point-in-time consideration. We compound it by now taking a point-in-time valuation and layering in price point precision. So to me, as a certified general appraiser for many years, I would challenge and throw out, I'm wondering if we can migrate towards, our German friends talked about their mortgage lending value, if we're even ready for a value range as a lender, lenders look within a range of value. There's a lot of, again, misconception around the use of appraisals, particularly in purchase transactions. You know, I have people anecdotally come up to me and say, you know, I bought my house for $328,500, and guess what it appraised for? And I said, well, probably $328,500, but I said, understand that if all that information is handed to an appraiser, he or she is basically performing an assignment on behalf of the bank to see if that is a fair price by which to begin to make your loan decision. So to me, that would be one consideration. Two is I think we have an opportunity to better and more consistently use data and analytics in the body of the report. We've had the same form for many, many years. Joan and her group have spearheaded efforts to try to re-engineer and redesign the form. And I think that is potentially a component of how we can improve. And lastly, I think we have an opportunity to, and I know some of my colleagues may touch on this as well, is to refine and re-engineer the cost approach within the body of an appraisal. So a consistent theme from day one was the value of land residual and how, you know, in the importance of that in a risk process. And it's something appraisers used to be very good at. Bill and I talked about it. My father was an appraiser, you know, and he walked me through all the steps as I was becoming an appraiser, and we spent a lot of time on the cost approach, both its benefits and its weaknesses, but overall the value of it. And I think that's an important component. So again, food for thought, potentially re-engineering, rethinking the cost approach, putting more focus on it since there's been a lot of data and research behind the benefit of understanding the underlying land value and the component and the percentage of land versus the improved. So I would throw that out for consideration, and I'll turn it over to Mr. Eric Schwartz.
Bill's done. The only thing between you and lunch is me. Not up there? There we go. All right, I'm Eric Schwartz, as I was introduced, Chief Appraiser, Amegy Bank, about 35 years, thank you, 35 years as an appraiser in the fee world and as a Chief Appraiser for a couple of banks and a review appraiser for a couple of banks. Appreciate the invite, thank you very much. And as I always, in all my PowerPoint presentations, after I've turned them in, I have an epiphany. Wish I'd included that and not included that other thing. And then I sat here for the last day and a quarter and said, you know, those are good ideas. I like that dovetails. But I wanted to touch on a couple of things first from the get-go. At first, they may not appear directly to relate to the risk in the housing market, whether it's single-family or multifamily, but they do play a role. And so all of the players in this arena need to understand that. We look at, and we're going to look at it real briefly here, the interagency guidelines that first came out in 1994, comparing them to the guidelines that came out in December of 2010. I always cite this. There we go. The increase in the use of the word independent or its variations and review and its variations, that, you know, having lived through all the cycles since 79 forward, you know, pre-FIREA, it was a real Wild West sort of mentality, especially where I'm from in Texas, in Houston, Texas. And now, post-FIREA, there's some wildness, but not as much. And that gets me to a point here where, and this is part of the problem. You know, academics can touch on various studies and research, but if we do not keep whichever value we're going to use, whether it's my word, the tradesman, or the analyst, if we do not keep them independent of loan production, you know, there's a major flaw in the system. And independence has to be from influence on the final opinion of value. Otherwise, we lose their objectivity. Now, to the point of conducting a study and sending 3 appraisers out to appraise a house, you're going to get as Tom pointed out, likely 3 different opinions of value. I was surprised by the wide swing, but stuff happens. And I'm not going to criticize Tom's work because I haven't delved into any of that scenario, but sitting where I sit every day for the last many years and having done forensic appraisals, an element of coercion is there oftentimes. Someone made the comment earlier today that appraisal reports, and I'm paraphrasing, are often used, or they are used, as negotiating documents, and unfortunately that may be true. I got a spine of steel and a hide of Kevlar, which oftentimes doesn't make me popular with loan productions. In fact, I'm never popular with them. I'll just state that as a fact. But I grew up with the mantra of keeping it between the ditches. The analogy is you're driving down the country road. If the ditch is pretty wide, you can pretty much go all over the place. But in our world, it's the regulations, it's the policies, and it's the guidelines. Those are the ditches. If you get in the ditch, you've fouled up as an appraiser. I can sit here and tell you about how I approach solving that problem. The first step is hiring the qualified appraiser and then requalifying them at some point in time down the road. Just don't assume that because today I decree that you're qualified that you're going to maintain that status with me. And that on our end is done through further review, random samples done by an outside reviewer or an inside reviewer. It's all about quality assurance. But I'm going to jump around on these slides a little bit. In that first bullet point on that slide, the high appraisal isn't the good appraisal. I think all of us, hopefully in this room, understand that. No knock on real estate agents, but I'll knock them. Oftentimes, for a single-family perspective, that's their view. I need a high appraisal, right? I have a long memory, and I have lots of emails from real estate agents passed on to me through the loan officer saying, don't use so-and-so because they never get it high enough. Really? I thought we want an independent opinion of value. No, we don't. No, we don't. I'm not convinced borrowers want an independent opinion of value. They want to close a loan. They want to close a loan, and they'll assume whatever risks and however they calculate that. I don't know, but they, the borrower of that single-family house, that's a home. It's not a house. It may or may not be their major investment in life. And they're looking at, can I afford the debt? Can I afford the insurance? And can I afford the property taxes? They're not thinking about replacement reserves like we do on multifamily or any other commercial property. So they really would benefit from an independent appraiser giving their professional opinion of value as best that they can. And if by God it comes in less than contract price and you have that contingency in the contract that it's contingent upon the appraisal, go back and renegotiate. Now you can't do that in Houston, Texas where it's a seller's market, but in a balanced market you can, and certainly in a buyer's market you can. But I keep on stressing this point that the appraiser, whatever their qualifications are on a scale of 1 to 10, they've got to be independent of the process, of influence in the process. Now, let's bifurcate the valuer pool. It doesn't take a rocket surgeon to measure a rectangle or to walk through it. It really doesn't. There's tremendous amount of data available, readily available like that wasn't available to me 30 years ago. I know I could do it with my daughter. She's brilliant, and she's all into data analytics on the medical side, and I could say, go find out everything about these properties and report back to me in 30 minutes, and she could probably tell me 90% of what I want to know. And I live in a non-disclosure state. I could get her into the MLS, et cetera, et cetera. So as valuation tools, should we move away from strictly the Fannie Mae 1004, which is a horrible constrictive thing, and allow that to be used once it's re-engineered in a different way than it is now, look differently. And then do we have appraisers that are really the analysts? You know, we say now, we call these things complex properties or high dollar properties, they're unique properties, et cetera, and they don't have an income associated with them. So we hire an appraiser who understands how to, you know, that unique property, that 300-year-old property, whatever it is, to value that. And then we have somebody different to do the track home cookie cutter stuff, all right? But I think whatever the scenario is, there will be situations where we will want the appraiser to give us some forecasting, and we don't ask them to do that now in single family. You know, in multifamily, there's a market analysis section that I ask my appraisers to give me to forecast based on the trends that they see now in published reports, et cetera, but we don't do that in single family. The system's not set up for that. It's a point-in-time appraisal. It's 3 comparables and a cloud of dust. That's all we ask these people. And how much of our economy is based on that? I mean, we've never had a downturn in our real estate economy, have we? You know, 35 years and living through all these cycles, you begin to understand that there is a lot of risk associated with picking that appraiser for that assignment. So we need to make sure they're qualified. And oh, by the way, there's fewer and fewer appraisers today than there were, what, 2012, I think it was? I forget some of my own slides. But, and most of them, excuse me, the median age of an appraiser is about 62. That's my age, you know? And they're not getting into the business, and it's going to get worse come January 1. It's probably already worse now because the requirements are being upped January 1, including for a supervisory appraiser. Who wants to take on a trainee? There's not too many people do. And what college-educated person wants to go work for peanuts as a trainee to someday get licensed a few years down the road in an industry that's going through this major shift? It's not happening. What's happening is the Scotts of the world are being repeated. You know, using an example. Their children are getting into it. My children are smart enough to, you know, go into medicine and accounting. All right? We're just not bringing up the people. The largest appraisal organization in the United States is dropping in numbers. It's down to 22,000. I think it was 35,000 15 years ago. It's down to 22,000. No one wants to take on the risk of training. So the marketplace has to replace the appraiser with something. I'm not saying in all instances, but at some point. You know, and I've got these wild ideas like, hey, if I've got a borrower with an 800 and better FICO score can handle the debt service is putting down, let's say, a minimum of 10% in a census tract or a zip code. Let's drill down to a census tract where that's been really performing well, small default rates. I'm gonna maybe not look at the collateral like I would for the family with a 550 credit score that can, you know, is at a 38%, you know, debt to income ratio, and is going to get a little bit higher with a mortgage. I'm going to weigh those things differently. Why, as Joan said, why silo? You know, be a little creative. I'd hate to see us get to the point where everything's done by an AVM, some sort of hedonic modeling, regression analysis, whatever, because I think you still need boots on the ground to look at the house. But, you know, our present system was developed decades ago, and it's really not working well. So anyway, appreciate the time. Thank you very much.
Thank you all very much for the opportunity to be here. Joan, Ed, everybody at AEI, I really appreciate the chance to participate both in the audience and then up here as a presenter. Been a number of very intriguing presentations already, many very academic. Mine's going to be a little bit more elementary, but the good news is it will be followed up with milk and cookies and a nap. So I think we'll probably enjoy that part of it. I want to talk about the appraisal process as it exists, how we've gotten where we are, and what we might be able to do to improve the process for single-family residential. Insofar as where we've been, and I want to thank George Mann provided me with some copies of forms last night from the early 1930s, which I hadn't previously seen. But I'm looking at this point from about 1962 forward. In 1962, a form was created by George Opelka's dad, Greg Opelka, thank you, which became known as the Green Hornet. It was the first real appraisal form to be in use for residential appraisal. It was followed in the 1970s by the creation of a form at Fannie Mae, and then ultimately in 1984, the development of what we currently call the Uniform Residential Appraisal Report was developed. The thing that these forms all had in common is that they all had a cost approach to value. We've heard a lot about the cost approach over the last couple of days. They all had an income approach to value, and they all had a sales comparison approach to value, and appraisers were expected to develop all three approaches. We look at this as an original Green Hornet. You can't see it in this slide very well, but really what I want to point out here is that you can see that the appraiser was expected to develop this replacement cost approach to value, and they had a sales comparison approach to value as well. And one of the things that was brought up earlier, and I think Noreen talked about the fact that when you develop a cost approach to value, at a minimum, you get a glimpse of what the upper limit for value might be for a property. I think it's also important to understand that you can get a look at the potential lower limit of value as well. We've seen a lot of REO properties, a lot of short sales go for far less than they should have because nobody was paying attention to what the replacement cost and land value might have been on those properties. Steve Olner talked about the breakout of land and house value, and if you look at, does this thing have a laser pointer on it? Anyway, over here, you can see that even on the old Green Hornet, they had the appraiser break out the land value from the improvement value as part of their final conclusion. So we were doing this stuff quite a long time ago. Now, at that point, we had cameras, and it was, we were developing some tools. Appraisers had data. We had lots of data. It was on the back seat of the car in the form of a book that got put out once a month by the Association of Realtors. We'd go back and enter the data. Some of us could even make phone calls from the field with our portable cell phones. We had good tools, right? Unfortunately, what's happened is that we've employed technology to change the way we take pictures and the way that we get data, the way that we enter the data, and we certainly have a lot more immediate access through improved communication systems to the folks that we need to get the data from. But we've been putting comps on a grid since before the most basic technology that we currently employ ever even existed. And I think maybe the most important thing, important point I would like to make in this is that a sales comparison approach to value, which is the predominant way that residential real estate is valued today, is not a value. It's a price. We have to accept that reality. When all I do is report what my neighbor did down the street, I know what they paid, but I don't know what the real fundamental intrinsic value of that property is. If we fail to develop additional approaches to value to cross-check what we've concluded from a sales comparison approach, if the sales comparison approach, the price estimate, happens to coincide with the real value of the property, in more cases than not, it was an accident. The appraiser doesn't even know how they got there. I'm sorry, I hate to be hard on my colleagues, but it's just the way it is. We got to stop pretending that this isn't the truth. 30 years ago, the data was hard to find. Everything was small data. the stock in trade of the appraiser was the data. And we've got to move to analysis and broader, deeper, more meaningful analysis of this mountain of data that's now available to us. Local and regional lending was the norm decades ago. We've had a migration to national lending. And the local lender, when they were retaining loan risk, cared about value. We've gone to this movement of risk downstream and a less concern about value at the institutional level. I think to some degree that's returning. I think one of the efforts of some of the regulation is to bring some focus back to value. It's a gentle push right now. It's not very firm, but it is a start. So again, everything was manual and it's now very much automated. So what are some of the solutions that we can employ? Well, appraisers have to analyze, I say dozens, but really even hundreds of sales every single time. The data's there. It's available. It comes to us with the push of a button and the click of a mouse, and we've got the analysis ability. We've got the tools with which we can conduct that kind of analysis. The appraiser has to use multiple approaches. As I say, a single approach to value may be right, but if we're not testing the reasonableness of that outcome with some additional approach to value, we don't know for sure whether or not it's right. And when that single approach is sales comparison only, I'm going to pound on this point until somebody hears me, it's a price opinion. You know, we've gone through this great discussion over the last few years about coming up with so-called alternative valuation products. And one of the reactions by certain members of the appraisal community is to develop an appraiser price opinion. We have that. It's the 1004. I mean, it's already there. We've got to understand what we're doing. So we have the big data. National lenders are expecting national solutions. It's a lot easier for a national lender to interact with a national appraisal company or a nationally based, somebody with national reach, and we expect that. So we've got to be able to equip the large companies, and some of my colleagues here have pointed out, diversify within those organizations. There's no reason why the inspection of the property has to be conducted by the valuation analyst every time. I could see us at a point where, you know, one person is looking at properties, another one is focusing exclusively on the cost approach to value. Somebody else is focusing exclusively on developing rental value, developing income. We could have other specialists within those firms that focus on the real market analysis, identifying neighborhood boundaries, market boundaries, and focusing on the broader analysis of that, and then bringing all this information together to the appraiser, to that analyst who will conduct the reconciliation of all this stuff and produce that final outcome. So much of this can be automated. What we always did manually can now be done with a great deal of automation. So we've got sales comparison, replacement cost new. You know, in 2005, the GSEs decided that the cost approach was no longer required. Interesting timing. You know, I'm not sure that eliminating the cost approach caused the problem or caused the crisis, or that failing to eliminate it would have saved us. But it certainly was a potential contributor to these appraisal errors that Tom was talking about so much. And in that replacement cost, they could be developing information about the reserve requirements that might be necessary based on the current condition and the expected remaining life of the various components. Appraisers can be using regression, market and sub-marketing indexing. Alan Weiss talking this morning about individual property indexing. What a beautiful thing that would be as an additional cross-check against the valuation approaches that have already been developed by the appraiser. So, you know, the next question that I want to ask and illustrate is how the way the appraisal community has been changing the language, the way that the education being provided has changed. So This you can't see very well on the screen, but this is a graph. I don't know if you're all familiar with something called Ngram in Google, but you can search, and this is just a search of all of over 130 million books that Google has indexed since 1800. I went from 1920 forward, but what we can see roughly is that the use of the phrase real estate appraisal peaked in about in the late 1980s and has started to tail off insofar as its appearance in texts. Real estate valuation is plain, and what you can see at the bottom is that there's been this little appearance of broker price opinion, alternative valuation method, and alternative valuation model. Well, if we break this out and start to look at them independently, we can see that real estate appraisal, again, was tailing off. And when you look at this more closely in the handout, or if you look at the slides again, you can see that there's a number off to the side, which is somewhat of it's an indication of the number of appearances. So the reason that broker price opinion and the others look kind of flat is that their appearance is lower relative to these others. But when we look at them independently, we can see that the incidence of broker price opinion, is that which one I'm on? Appearing in academic literature is taking off like a rocket. So it started to appear in about 1990 and it started to take off. The next one we see is, I keep up with myself here, automated valuation model. And of course, they've been around for a little bit longer than this graph would indicate, but they started to appear, that phraseology started to appear with great frequency in 1997. I find it fascinating that alternative valuation method began appearing in 1956. And in fact, we were talking about this more 2 decades ago than we are today. I found some articles that talked about the need to develop alternative valuation methods going back into the early 1990s. And here we are all this time later talking about it, and not much has happened. I think it's also interesting to observe that when we talk about the individual approaches to value, we're not talking about the cost approach as much as we used to in our training. We're not talking about the income approach as much. Even the sales comparison approach isn't getting discussed. But more important is, look what's happened to income capitalization, land residual, and replacement cost new. They're disappearing. And these are really important methods for developing and understanding this underlying intrinsic value that we've talked about so much over the last couple of days. So there's so much more I'd love to say, but you know, we live in a big data world. We need to abandon the small data methods of decades ago. We have analytics that enable us to identify the right data. So much of what an appraiser does today is go out and gather information about a property that hasn't got anything to do with the valuation process. I'm not sure it matters much whether the gutters are vinyl or metal. I just don't think that makes a big difference. But that's the kind of stuff that we're sending the appraiser out to figure out. And as I said, the multiple objective measures of value will make for much more credible value conclusions. We need to teach and train using modern methods and techniques. And I think that a thorough and sophisticated analysis will enable better decisions, and it will certainly attract better talent to the profession. As was pointed out, the beginning January 1st, 2015, to become certified as a residential appraiser, an individual will have to have a 4-year college degree. That's great, but what we've really done is raise the barrier to entering the profession and simultaneously lowered the appeal of entering. And that is going to, we are headed for a real problem insofar as appraiser numbers. If I've just spent 4 years in college studying statistics and economics and business and finance, and then you tell me I can come out here and fill out forms for 2 years at next to nothing and get yelled at all day by 19-year-olds at appraisal management companies for my spelling mistakes, wow, that sounds thrilling. I can't wait to get started. You know, college graduates are not going to be finding this as an option. And I think it's important for us also to understand that we really need to distinguish what's going on in residential valuation from commercial. As I think all of our commercial appraisal colleagues will attest, that the process of developing valuations for commercial properties does use multiple methods. The client interactions are more professional. The appeal to a young college graduate of entering into a line of work that's going to put them out there valuing 57-story high-rises and baseball stadiums, that sounds okay to me for a college graduate. If we don't bring more sophisticated processes and analysis to residential, we're not going to attract the kind of people that are capable of performing that stuff, and we're going to have to rely on AVMs. We're going to have to rely on indexes, and those alone, I don't think, are going to do the job. So anyway, at the risk of me babbling on endlessly, I will hand that to you and see where we go. Thank you.
Thank you. Time for questions. Steve?
Hi, this is a question for Bill. So Bill, one of your main points was that in this big data era, appraisals are not really taking advantage and leveraging available information. So two questions really. Why hasn't that happened? Why hasn't there been some competitive pressure so that firms that actually are capable of doing that would drive others out of business and haven't done it? And second, if that hasn't happened, what are the impediments and what would be the couple of things you would think would have to be done to make that possible?
Thank you, Steve. Excellent questions. First of all, I think one of the main problems is that the currency of residential valuation is the GSE form. And as long as that continues to be the primary tool, you know, as I said recently at another conference when this came up, that part of the problem is that when all you have is a hammer, everything looks like a nail. And so because that's the only tool, it's the one that gets used regardless of what the actual problem to be solved is. So unfortunately, as long as that remains the currency, and it isn't just the GSEs, it's companies like mine that are in the business of helping lenders analyze their valuation data, our systems are geared to dealing with that form. So it's going to take a rather significant change in thinking from the top down in order for us to be willing to abandon the form and go to a more a meaningful way of going about it. There certainly have been attempts by some really good people. I know Greg Stevens' company has been developing some alternative valuation products that don't fit the cubbyhole over at the GSEs. And I think he would probably tell us that getting traction for that has been a challenge because everybody knows what the current form looks like, and they look at something new and they just can't figure out how to make it fit in the box. So we've got to figure that out. You know, it's also interesting that with all of the data and with the ability that we have to collect the data in a different way, we can feed many different types of outputs. One appraisal, one residential valuation can be, when that data is brought in, can be dispersed to a form that works for the lender, to a different format that works for the investor, to another format that works for the homeowner, so that everybody gets the elements of that data that mean the most to their decision process and in a format that they can use. The form's a style sheet. It just sits on the screen. It's not really anything meaningful insofar as what it really is. So I hope that answers the question.
May I offer one more thought in regards to that? There's 2 points. First of all, there's now a significant legal and regulatory emphasis here. So anything having to do with innovation is going to also run into friction from the regulatory side and the legal side, because what regulations are designed to do and so forth is now, many of these issues are now not only good or business practice issues, or maybe not so good, but they're also matters of federal law and federal regulation. So when you want to go move the needle there, it's now a more complicated conversation. One more point about what I've learned from being around the mortgage industry for a long time is an appraisal is not only an estimate of price, sometimes thought to be an estimate of value, but it's also a license to manufacture a loan. And so there's a significant economic incentive to keep the process as efficient and as standardized as possible, because people need to manufacture that loan as efficiently as possible. So there's a number of factors there, both economic and legal, that I think are getting in the way.
I just want to add to Tom and Bill. Fannie Mae already aggregates the data. They've had their uniform data set for some time. They have a population of several million properties. I don't know what the threshold needs to be, or I don't know what the metrics are at Fannie Mae or any other, but it would seem to me if you're aggregating all that data in a uniform fashion where variables, identifiers are all coded uniformly, you can analyze that data. And if we make that paradigm shift where the secondary market can say, the values between X and Y, the credit score is X, income levels are such, debt coverage ratios are such, I don't need the Fannie Mae 1004, but I do need a nice photo of the interior and the exterior. And I will accept the assessor's information on the physicals of the property, the site size, legal definition, improvement size, age of the property, and I will accept that the MLS data that it's a 3-bedroom, 2.5-bath, 2-car garage with an unfinished basement, and the borrower signs a certification that yes, that is true, and let's make the loan. I'm not to put appraisers out of business, but I'm not going to be an advocate for inefficient systems either. Within those are just a rat's nest of risks that I don't know we can all identify clearly and understand. Thank you.
Before I go on to Penny and let her ask a question, this is probably as much a political statement as it is a policy and practice analysis, but in the present environment, the fact of the matter is Fannie and Freddie control the entire appraisal process. And we have prima facie evidence that they are really bad at collateral risk. I don't know, other than $1 trillion, how we get anybody to focus on the fact that collateral valuation is of prime importance when you're making a real estate loan. It's nonsense to conclude otherwise. So what needs to occur very succinctly is Fannie Mae needs no longer to control the appraisal process. An independent agency needs to be established and be completely independent of the GSEs. Whether it's it's an FHA loan or a VA loan, we really should have a standardized process. What the risk tolerance is on any given segment of the market is up to each individual entity. Penny?
Real quick, Penny, before that, and the only problem with that is that's going to need to be their idea for them to embrace it.
Well,
because I think to Tom's point, and it as inefficient and as broken down as the process may be in whatever current state it's in, it's at least an efficient delivery of them to the information Eric spoke of, all the data they want to collect. So they don't have a lot invested in maybe necessarily improving that process other than letting us run around the track with crutches and still delivering it to them in some fashion. So that's a great point.
Sure. With UCDP, we've now created, UCDP was an archaic system before it was ever launched. It was an old data standard. As Bill pointed out, we're collecting the wrong data. I mean, we really don't need to know if we have double hung windows or single hung windows. My concern is that Fannie's analysts are gonna look at that and go, wow, red front doors correlate to defaults. I mean, they're gonna take non-correlated data and come to some ridiculous conclusions and force a repurchase because you made a loan, Bank of America, on a house with a red front door.
I should write that down.
Yeah, okay. I'm sorry, Penny?
So my question is, and it's to everybody on the panel and everybody in the room, how do we get to the point where, as an industry, we can get together? There's more of us than there are of them. When we talk about Fannie and Freddie and their appraisal standards, because we have gotten to the absolute point of ridiculous. And a part of it is unintended consequences. You know, you talk about independence, the separation of production from the appraiser. So production's all on the other side of that wall. So you don't know why they're asking for what they're asking for because you don't talk to them. They don't talk to you. And sometimes they're asking for it because you identified that as something in a repurchase demand, right? And so it's not part of an official guideline, but they start asking for it. So you have Fannie Mae ask for additional photos. They want the interior. And then I think it was at your last, Joan, at our last CRN, Fannie Mae said, you'd be surprised at how many times the interior photos were fraudulent. And my response was, no, I wouldn't. That's exactly what I said would happen. If you want a picture of running water, I have a sink. You keep asking for ridiculous things, you're going to get ridiculous answers, right? So we are, as an industry, we keep saying it's too hard. It's too hard to go against Fannie and Freddie. It's too hard to go back to legislation, but we have to do it. Because it gets to the point, and at Bank of America up there too, where, and I've said this before, if it gets to the point where it costs me more to do a collateral valuation than it does for me to reserve to not have one, then I'm gonna dispense with the whole business. It's stupid, right? And it is rapidly getting to that point. Not that the appraiser's making the money, but I get to, every time I get an appraisal, I get an AVM and I get a review and I get all this other stuff because I'm trying to make sure I can stand up to a repurchase demand or some investor question down the line. And so you're adding the cost, but you're not putting that money where it belongs, the person who can tell you what they actually think, their expert opinion. They're only telling us what they can prove, and I can prove that too. So how do we do that? How do we stand up and say enough's enough?
Well, obviously, unfortunately, it's a political thing. Appraisers have absolutely no power at all. I mean, there's 80,000 appraisers, and as Eric said, they're all in their declining years, shall we say? We're not making new ones. There's no economic incentives for anybody to manufacture a new appraiser, and we haven't figured out what their role is. We pay them horribly, and I mean, the list goes on and on. So honestly, I think we need to have some politician that understands the issue. I hate to think, you know, we're leaving the solutions in the hand of Congress because not exactly a lot coming out of there these days, but we need to blow up FIREA. You know, it was, what, 1989? I actually started in the appraisal business at a savings and loan in 1981, so I know, and I did it backwards. I started as commercial and ended up in residential. And I remember as I was being trained, I had a great mentor. And she's like, well, you know, a fireplace is $2,500 adjustment. And I'm like, where did that come from? Just trust me on this. And so, you know, and by the way, you know, a garage is $5,000 adjustment. So in the last 5 years or so, I had a friend of mine who was developing a regression model, and he goes, you know, I'm having problems. My model keeps showing a garage adjustment is $20,000. I'm like, well, that seems logical to me. Why would you think other? Well, I've been using $5,000 since 1982. I mean, why? Those are, you know, some of the infallible rules we have in appraising. So honestly, I I think we just need to start over. We need new forms. We need access to better data. We need to put some integrity into the process. We need to have policies that make sense. So we got a lot to work on.
I have a question in terms of body. You mentioned that the body of appraisers don't have enough political clout to really move the needle. What organization, what body of people do? Is the investor community, do they have enough clout? Do they realize that what they're getting is stuff? But unfortunately, their stuff is government guaranteed, so maybe they don't care.
I mean, I think NAR has a strong voice, but you know,
They're our best friends.
imagine that. So, and I think lenders do a poor job, to Penny's point, and for those of you who don't know, Wells Fargo, Bank of America, we talk a lot. I think lenders have a role in the solution. I think professional organizations, Appraisal Institute, I think they clearly have a voice and a role. But the trick is, I think, engaging at a GSE level to have them embrace whatever change we promote.
Now, fundamental change at the GSE, I have a snarky question. Which comes first, fundamental change at the GSE or peace in the Middle East? Which?
Peace in the Middle East.
I agree with that, John.
And since you wanted everyone on the panel to answer, yeah, I don't know the answer to that question. I will say, since this, we're talking about housing, and I was remiss in really not discussing anything about multifamily. There are problems there. Drilling down, I get a multifamily report to review. I read a little bit about the subject in the first few pages, then I go to the income approach. And if there better be a DCF done in Argus, and then I'll look at their input assumptions, and I'll run Argus and input my own assumptions. Is this reasonable? Now, the danger with all that in Houston, Texas is everything's going up, right? But I've lived through the ups and the downs and the ups and the downs and the ups and the downs. And this will all plateau before we see some declines. To your question about talking to loan production, I was a little bit remiss. I think put everything in the bucket of outside the influence of loan production, and that pertains to anything to do with opinion of value. I'll talk to loan production all day long and stop them dead in their tracks when they bring up value. And people that work with me have learned that I'm pretty truculent about that. And I don't mind sharing that in public with them in front of other people. Don't talk to me about value, because we're hiring somebody to do that for us. And if I need to hire 2 people because it's a complex property, I'll hire 2, right? And on the residential side, that's in the state of Texas, 95% of the problems reported to the state board are residential, single-family residential, and they all center around the Fannie Mae 1004 form. There's some consistency there. Single-family residential, Fannie Mae form, and dumb, appraisers, or they're flummoxed, or they're getting so much pressure from underwriters and maybe from AMCs that they're running scared. So, there's a lot here that can't be solved today, but certainly I think we need some sort of, I think you said the word blow up. I like blow ups.
Yeah.
I think we need to blow stuff up.
Makes people nervous, though, Eric, Ed.
Yeah, I
Okay,
think.
so
Go ahead.
I think now that you've concluded, Dorothy's, that you're not in Kansas anymore. So, and that's sort of a epiphany right there, having had this conference for 3 years now. Maybe you should look and see who's wearing the ruby slippers. So, as to the first point, this data issue, first of all, there's been big data for 100 years. The Hurd book had big data in 1903. As far as big data goes and data access, Fannie Mae and Freddie Mac are the secondary market. Who's the primary market? Bank of America, Amgen, Wells Fargo. You have the data. It all flows through you. You're wearing the ruby slippers. Don't complain about Fannie and Freddie's black box when you've got the data slipping through your hands. that's number one. Number two, to what Penny said, it seems like what is needed is you want to know three things. What's the current market price for that house? What's the accuracy of that current market price? Because there is a big range of accuracy about that, and you talked about that in terms of the cookie cutter house versus the non. And then what's the volatility around that house, which really gets to sort of the fundamental value to some extent. I mean, those are the three things that you want to, I think, figure out. So now then the question is, that's the output you want. How do you get that output? Forget the 1004, which is irrelevant to that. The 1004 is irrelevant to all three of those things, because as you've shown, the current price is wrong much of the time. It certainly gives you nothing about accuracy, and it gives you absolutely nothing about volatility. So I don't know what your reaction is to that, but that would be my suggestion.
I have Penny, a question for Penny. We're talking here about how, I guess, to get the appraisal right, meaning the right value, the right price, the right volatility, and all that stuff. Which is the bigger problem to you? Getting the appraisal right, the right value, or just making sure that you have the proper reserves in case something goes wrong?
The whole point of having the appraisal is to make sure that I'm adequately balanced. And there are multiple ways to do that.
Mm-hmm.
The fact that I can use an appraisal keeps a vibrant secondary market, right? Because I don't have to use all my money in reserves.
Mm-hmm.
So it essentially is that adequate collateral? And today's appraisal doesn't answer that question. Because I think there are plenty of times where we can make that decision, but that bears no resemblance to what the secondary market does. So it's a question. It has become, when you look at that 1004, the first time I saw the new version, my first thought was somebody's building a giant cross-sell marketing database. Because there's nothing about that is helping me with value. It's helping me know every little minute detail about that house. Whether it's double hung windows or casement, or whether it has an alarm system. It's really a great privacy tool. But it doesn't help me with value. And that's the thing. You need the person in the local market who knows that market to tell you what they think. But we're nowhere near there anymore. We are only having them tell us what they can prove so that we can prove it to who we sell it to, so that they can prove it to who they securitize it with. It's that whole chain. So if we don't all get together, like you were saying, the appraisal organizations don't have enough clout all by themselves. We may have the ruby slippers, but we're also staring at that house that's about to come down falling on us if we have to repurchase everything. So it's got to be the groups getting together to figure this out, because otherwise we just all are staying our individual victims of what we know is a broken process.
So Ed made a great point, separating, in my view, risk and value.
Yes.
And I think there's an implication in a lot of this discussion, and sometimes we appraisers can get all ground in, but that we're looking for the solution to have all that be embodied in a report. And so again, the point's very well taken. Don't, as a big bank, worry about, we wonder what the risk. Well, you should be able to analyze the risk. In other words, the value that an appraiser brings, his or her experience and the discretion and weighing everything. That's a point-in-time valuation, which we've had some dialogue around. But then put that into your risk model. Put that into your risk process. Throw that to the quality review folks inside the bank. So I think that is an important distinction to make. And I think, starting with that potentially, maybe then we can put some boundaries around the discussion of what's this appraisal going to look like. And it may free us from all the analytics and all the data and all the burden we're going to put on an appraiser, and what are we going to compensate them, and who's coming into the profession, and all the things that we worry about. Maybe that'll help a bit. So anyway, that's my quick 2 cents.
Right. If you look at right now, it seems the collateral value is escalated in importance in the transaction because we did such a terrible job for so long. But at the end of the day, the only time that becomes important is if the borrower defaults. So lenders, creditors should be focusing way more on is the borrower going to default aspect of it than they are on the collateral. But They're not going to because we're doing such a bad job on the collateral.
This gentleman.
Yes, sir.
Now see, we're going to make her run farther with the microphone. She was over there. Oh, sorry.
So we oftentimes hear people say, if we could just know what the right price or the right appraisal, and then we know what the right LTV. And I think the reality is, for any property at any point in time, there is a distribution of values.
Correct.
Depending upon all the potential people who might come and look at this and how well of a fit it is, how long they expect to stay. So then you say, if there's really a distribution of values, even if it's relative values at a point in time, how best should we convey that? Now, conveying it through one number, and we don't even know what it is. Are we saying, is the appraisal the mean, the median, or is it some percentile? But any one number is going to be a very poor description of that distribution. And so part of it, I think, is how do we get closer to understanding that distribution and conveying it in a little more detail and nuance?
Well, I think that is part of the problem is the definition of market value is flawed. In FIREA, we talk about it. Pre-FIREA, it was the highest price paid. And, you know, Ed, through his research and conversations with Jack Weaver, who was chief appraiser at Fannie Mae in the 70s, the evolution of the definition of market value, and this was something I learned from Jack, grew out of eminent domain. The appraisal profession began with government takings. And so the government, because they were taking property, felt obligated to pay the highest priced. Unfortunately, that translated to lending policy, and we learned through the S&L crisis that didn't work real well. So they rewrote the definition of market value and changed highest to most probable. That's better. Unfortunately, it still says most probable price. So in the definition of market value is, you know, a buyer, a willing buyer and a willing seller each being knowledgeable and arriving at that number. Well, motivations can be different, and we still appraise to a single point in value. And to your point, there is always a range. What we need to do, and we have modern methodologies where we could easily ask risk questions and dial up that LTV depending on other risk factors. Is there a single employer in this small town? When Ford moves out, values go to zero. So what's the risk of that happening? An appraiser might know that there's rumors that the Ford plant's going to close. Nobody ever asked them the question. Nobody ever asked them if, you know, Lake Erie is on fire. Nobody asked them these exogenous things outside the lot that affect value. You know, we have fracking in Texas, so some of us go, we have a bubble going on, and people are moving there in droves. So when fracking ends, the bubble will pop, but you have to be rational. If you ask an appraiser, and Tom's example in Nevada was great, they went back and looked at the data and it supported the value. Well, any fool would know that property values won't increase infinitely at 20% a month. A middle schooler could figure that out.
It was the price that was supported.
But we have quants who were writing models that said that will never happen.
But real quick before, that was a great point, and I think as a bank, as lenders, you know, sometimes it's perceived that we're waiting for that appraisal as if we have no idea what, you know, I wonder what it's going to appraise for. We should know. We should have that distribution, that data set, and those analytics to have an idea. And then
That
should be
Yeah.
the first test of reasonableness is why is this variant from our data pool or the preponderance of the data or whatever? Or what did the appraiser learn with the vertical or horizontal cracking of the foundation? Okay, that's an issue, so, or whatever.
Two of a number of things that drive economists crazy who end up teaching valuation, like me. One is the point about the idea we're supposed to teach students to give a number, a point estimate, rather than an interval. But we need to change the form and the process at the appraisal end to get the interval figured out. But the use of the interval has to come at the user end. They have to, you know, this isn't just or even primarily the appraiser's problem. And the other, where it's the same general issue, is what Joan is picking up on, the dynamics. Anyone who underwrote, you know, who looked at valuation in 2004 in a lot of markets the same way as they did in '96 or today is an idiot. But you can't just give appraisers at the appraisal end the ability to say appraisal should be, valuation I should say, should be forward-looking and take into account market conditions, but you can't give the appraiser the ability to make that call. That has to be done by a disinterested third party, and then it has to be, basically what you have to do is give haircuts or maybe add a wig occasionally that varies by time and by market. And until you do that, you know, appraisal is going to continue to be a joke.
Oh,
Time, we're done.
we're done?
Thank you.
Oh, thank you. Ed, did you want to say anything, conclusion? Okay.